What happens to your retirement income when one spouse passes away years or even decades earlier than the other? Welcome back to Money Not Math episode 169. In episode 162, we explored what retirement income might look like with 500,000 in an IRA plus Social Security. After that video, one of our viewers asked a great question. Doesn't seem like there wouldn't be a benefit in filling the 12% as well as 10%, especially when considering one spouse will pass away. Let's say at 78. Would you mind showing this scenario? Or put differently, it seems like there would be a benefit in filling 12% tax bracket with Roth conversions as well as the 10%. That's an important point because life doesn't always go as planned. Shocking, I know. And losing a spouse can dramatically change your retirement income, taxes, and overall financial strategy. So today we're going to walk through a hypothetical scenario to show what happens when one spouse passes away earlier than expected and why planning ahead for this possibility is so critical. We'll also highlight the role of asset allocation, Social Security planning, tax strategies, and spending plans in protecting your financial future. Let's dive in. So I'll share my screen now. If you are listening to this as on a podcast, I would strongly encourage you to, try to find the video if you aren't able to see it with your podcast. Otherwise, I'll do my best to highlight the numbers to hopefully make this valuable for you. So as we jump over here, this is virtually the same situation as I had before for episode 162. It's a very simple situation. Most people obviously have a lot more details, but I don't want to get too in depth because this is hypothetical. They have $500,000 in a traditional IRA or traditional 401k. Either way, it's tax deferred. So they did not pay taxes while they were working, and now they will owe taxes in retirement. Their income is based on their Social Security and at age 67. And the one adjustment I made is on 162. I had them both have the exact same Social Security, which is very unrealistic. So for this one, I just Googled what's the average Social Security for an age 67 male, which is $2,393 according to Google, and I think Kiplinger's. And then I asked what's the average Social Security for an age 67 female, and they said 1,915. So there's a slight difference, which is extremely important when it comes to your planning, and we'll get into that a little bit later. But just keep in mind, everyone's situation is different. Everyone's Social Security's incomes are different. But unless they're the exact same, the timing of when you turn on your Social Security does matter. And the goal is they are both going to retire at 67 with $5,490 of monthly expenses. And the reason why I chose $5,490 is because we want to aim for about an 80% probability of success. The reason why we aim for 80% for most people, some people are more aggressive, some are less, is because in retirement, there's two great risks or guardrails to our planning. If you imagine driving down a road, on the left side of the road is the ditch or oncoming traffic, which is the worst case scenario, and that is running out of money before you run out of breath, or running out of money before you pass away, or as one viewer has debated with me, not necessarily running out of money, but only having Social Security. So you've ran out of flexibility, lifestyle choices. You have to do what Social Security allows you to. On the other side of the road is the risk of not enjoying your retirement as much as you could have. Now, we specialize in helping people turn a lifetime of hard work into a confident retirement they can enjoy, but that enjoyment part's important. If we spend our whole retirement just white knuckling our money and being terrified of spending it because we don't want to run out and we die with way more money than we needed or intended to, well, that's a lost opportunity to enjoy your life. The whole point of doing any of this is for enjoyment, right? For most people, I would hope. So that's why we find 80% is a really healthy probability of success, where if we get up to 90%, we can probably spend more if we'd like to, or go on a vacation that we hadn't planned. If we get down to 70%, we might need to tighten the belt a little bit until we can get back up to 80% and let our assets recover. So that's where that came from. The $5,490 is why I started there. And you'll see both of the Mr. and Mrs. 500,000 in retirement are 67. Mr. 500,000's life is going to pass. He's going to pass away at age 78. Sorry, generally men pass away earlier, so I chose him for the viewers request for this video. Whereas the Mrs. 500,000 is going to live to 95. Now you might be asking, why 95? That's longer than the average human lives. You're right. According to socialsecurity.gov, her life expectancy at age 67, or the average female life expectancy who is 67, is 87. Some will die sooner, some will die later. However, the important thing when it comes to retirement planning is understanding that when two people enter retirement together, and they're both about 67 years old, there's a depending on what source you look at, there's about a 50% chance one of those two people will live to 90 plus years old. So it's extremely important to plan for that, which I'm so happy that the viewer asked me to run through this scenario. So that's anytime we can toggle, the future is not predictable. We don't know what's going to happen, but we have to do our best. We have to do our best to put in accurate information or the best information we can so that we can make the best decisions possible moving forward and constantly update. Retirement planning is not build it once, set it and forget it. It's a constant adjustment to what's happening in our lives, what's happening with our assets, what's happening with our children, what's happening with our spouse, what's happening with our health. There's so many things that go into it that it's not something we can just ignore. We are constantly reviewing and updating our clients' retirement plans. So that's kind of the stationary information of age, life expectancy, spending amount. However, the other information we have to be aware of is the decisions we get to make that make a massive impact on the success of our retirement. The first of those, I'll just go down the list, and there's more than this, but these are the common ones that impact virtually everyone, is asset allocation. Where you put your money. Your asset allocation is all your money in cash? Is all your money in gold? Is all your money in stocks? Is all your money in bonds? Or do you have some combination? Now, I just started this situation with a 60-40 portfolio, 60% stocks, 40% bonds, because I think that's kind of like the standard that most people have heard at least talked about. And what that allows, and that gets us to our 80%. So let's look at some alternatives. On the one end, if you listen to the news and you listen to water cooler talk, they're almost always trying to scare you into clicks and ads by talking about market volatility and how it's this terrible thing. Market volatility will kill you. And it's if the market's way down, you hear nothing about it. If the market's up, just wait till it comes back down. It's almost always negative, right? And the reason for that is because they're trying to sell you ads. They're not necessarily trying to help you, right? We have to be very aware when we watch the news or market pundits per se or experts per se. If they aren't your hired fiduciary financial advisor, they have no obligation to do what's best for you. They probably have an obligation to whatever company is paying them to be on the air or doing a podcast or whatever it may be. So if we go all the way to this conservative side and we allocate our money very in a preservation portfolio, which might be 0% equities and all bonds and cash, or 10% equities and the rest bonds and cash, to avoid market volatility, what happens is our probability of success goes from 80% to 34. And you might be thinking, well, why is that? We've avoided market volatility. The problem is inflation, right? If inflation is simply 3% a year, about every 20 to 21 years, everything you buy now costs twice as much. So if your income stays the exact same through your retirement, your lifestyle actually has to decline because your purchasing power goes down. So you can actually be too conservative with your investments to a point where it actually increases your risk due to with inflation. On the flip side, what if we get ultra aggressive and we put our money in the most aggressive portfolio we can with the 90 to 100% equities? What does that do to our probability of success? That brings us from 80% to 86%. That's a 6% improvement. That's a good thing, right? The problem is, and if you're wondering, this median ending portfolio is the software runs thousands of simulations, and it just takes the median amount of money remaining at the end of the second to die spouse's life. So in our status quo portfolio, the median ending portfolio is 477. And the most aggressive asset allocation, it's an 86% chance of having about 955,000. Could be more, could be less, but that's the median. So by allocating more aggressively on the short term, hopefully you're really good at ignoring the news and ignoring your brother-in-law and ignoring your terrified friends who just want to talk about the negative market and the news that day. On the positive side, you give yourself a better probability of success. But most people don't allocate that aggressively because when the market comes down, you're going to see a lot more swings. And it's extremely important to have a reserve or an income reserve that isn't impacted by market volatility. And that's what we build for our clients is that we like to segment their money so that we have our annual income. We have an annual income reserve so that no matter what the market's doing, we aren't worried about it. And then we allocate the rest or a certain portion towards fighting inflation. So it's very intentional about where we're allocating our money. But I digress. The point is, if you can go we can go in preservation mode and avoid market volatility, but then put yourself at risk of inflation, or you can go super aggressive and fight inflation, but now you're putting yourself at risk of the emotional roller coaster that is market volatility. So that's the first thing to understand when it comes to your options. I'm not going to go through every single one, but it's important for you to find out what makes the most sense for you in your family and how you want to allocate your long-term strategy. So that's the number one thing you can determine. All of this planning and all these choices we get to make has nothing to do with having more or less money in your account. It's simply just what triggers or choices you want to make for yourself that could potentially help you or hurt you if you don't even look into it. All right, so that's asset allocation. Now, Social Security is a big one. Many people will just assume, oh, I should take it as soon as possible because you never know when I'm gonna die, or I should wait as long as possible to maximize my benefit, or I should just take it at my full retirement age because why wait any longer, right? There's a lot of like rules of thumb out there that may not be helpful, but let's take a look at how Social Security optimization planning can impact this situation. So if we come over here, if we look at the Social Security, the current strategy is assuming they both turn on at age 67. The optimal strategy says if Mrs. 500,000 applies her own spousal benefit at age 66, so she turns on her full retirement at age 66 because she's born in 1959, and at 1960 or later, pretty much everyone full retirement age 67. Before 1960, it's a bit staggered. So this situation, her full retirement age was age 66. And then Mr. 500,000 waits to age 70. So you'll see she's turning it on early, she's the blue, and then age 70 they're both on, and it's bigger than if they would have both waited till 67 or both turned on at 67, which is the gray. What does that tell us? If they were to do this strategy, they would end up with 157,000 more Social Security income through their retirement, their combined retirement story. And that's a pretty big number, right? So we have to understand and notice in doing that is that the gray bars, like I said here, I'll just get rid of it, make them both the same. If they both turn on 67, it goes up for each of them with cost of living adjustment from the Social Security Administration. And then when Mr. 500,000 passes away at 78, what ends up happening with Social Security, and this is a very important point for everyone to understand, is that when one of the two spouses passes away, the smaller of the two benefits, regardless of who it is, falls off, and the bigger stays. So now Mrs. 500,000 keeps her husband's Social Security benefit for the rest of her life, and it keeps stepping up. So that's the current strategy if they both turn on 67. Now, if they do the optimal strategy, now we're looking at the blue bars here. You're going to see it's just hers for the first 3 years, and then they turn on his, and it's slightly bigger than the current strategy, which is 60, which is the gray bars. And at age 70, their Social Security income is almost $6,000 more than if they would have both turned on 67. And then when he passes away, now she keeps his benefit, which is $9,000 more than if they would have turned on at age 67 rather than waiting till 70 for his. And she keeps that for the rest of her life, which is what creates the $157,000 difference. So just Social Security in a vacuum, just looking at that, there's a big difference on when and how you turn it on. So strategizing around it's very important. With that, when you strategize is very important because note, if this hypothetical family or couple walked into my office the day they turned 67 wanting to build their retirement plan, we couldn't even use the optimal strategy because it's assuming she should have turned on age 66, but she's already 67, so we can't go back in time, right? So it's important to plan before you intend to retire. I encourage people 3 to 5 years. Let's get everything in line. Let's be really clear on what your retirement income intentions are so that we can make these decisions in time to be as efficient and optimal as possible. If the longer you wait, the less choices you have. Now that we understand Social Security in a nutshell, or in a vacuum, let's look at how it impacts the big picture. So if we switch to the optimal Social Security strategy, where Mr. 500,000 waits till age 70, whereas Mrs. 500,000 was able to turn it on age 66, now their probability of success goes from 80% to 87%. That's a pretty significant increase. So we'll bring it back to the status quo, right? Asset allocation, extremely important. Social Security strategy, extremely important. Now tax strategy. This comes down to the root of the person's question from my last video of Roth conversions and what tax bracket to fill up. So let's come over to our tax planner here and figure out what is the best tax strategy for this couple. And what they're saying is the ideal tax strategy when it comes to tax adjusted ending assets is to do Roth conversions up to the 10% ordinary tax bracket. So if we come over to the comparison here, and I'm not going to go through all of these, but federal taxes paid. If we fill the 10% tax bracket like it recommends, we're going to see that the blue bar, or here, I'll start with nothing, just so we can be clear and not confused by the colors. If we do no Roth conversions, what's going to end up happening is I don't like this. It's showing me multiple. I apologize. I'm going to put this back. All right, so the blue color is if they do no Roth conversions, and you'll see at age 72, their required minimum distributions are going to start kicking in, and the government's going to force them to spend a certain amount of money. And then age 78, when from 72 to 78, they're married filed jointly, but at 78, when Mr. 500,000 passes away, now Mrs. 500,000 is filing as an individual taxpayer, and therefore she has all the same assets. So now her federal taxes paid make a significant jump from $3,000 a year or from the reference strategy $6,000 a year to $15,000 a year until she gets to about 88 years old and has spent down most of her tax deferred assets, and then that comes back down. Whereas if we could do a 10% Roth conversions, post strategy, we start paying taxes at age 67. We get to level those out more so that when her husband passes away, it's not as dramatic of an incline. And that's the green color behind the blue, which is a little bit harder to see. But the point is, at its peak, the highest amount at age 79, the year after her husband passes away, if she does Roth conversions leading up to her husband passing away, she'll only owe $5,369 in taxes. If she hasn't done Roth conversions in this hypothetical situation, she could owe $15,000 in taxes. That's a big difference. That's 3 times difference. And overall, if she does 10% Roth conversions, she could end up saving $86,000 in federal taxes paid. And that doesn't even account for Minnesota state taxes and things like that. But every state's different, so I'm not going to get into that too much. Now, his question was specifically, what if we did the 12% bracket too? Let's look at that. So now the 12% bracket shows this. You'll notice that they're actually paying less in taxes than the 10% bracket overall, but you're creating a lot more in the early years when it may not be necessary to do so. The benefit, and this is where everyone gets a choice, assuming they look at their options, is by paying $11,600 the year one up to $13,000 in age 72, they owe no taxes after that because they've basically done a Roth conversion all their money, compared to not doing Roth conversions and having the government come in and tell you when you have to spend your money, which is fine, except for if you don't want to take it out, it might mess up your Social Security taxes and your Medicare costs when you really don't want it to. All right, so that's a really good example of 10% Roth conversions versus 12% Roth. I'm filling up 12% bracket Roth conversions versus no Roth conversions. Require minimum distributions. Again, you'll see by doing a 12% tax conversion, there's 360,000 less total RMDs. So that's less of the government telling you when you have to take distributions. And if you do a 10%, if you fill the 10% bracket with your Roth conversions, you're going to spend 120,000 less in RMDs or required minimum distributions. So again, every situation is different, but that's a really vital example of how Roth conversions may or may not impact your flexibility and freedom to spend your money when and how you want to. Because required minimum distributions are required by the IRS. Otherwise, you pay some pretty significant penalties. So if you want to have more choice on when you spend your money and you want to protect yourself from the potential that one of the two spouses passes away way earlier than the other, which pushes the remaining spouse into a much higher tax bracket, then Roth conversions may be a good idea for you. So now that we understand how Roth conversions and tax strategies can work in a vacuum, let's come back and look at how they can impact the big picture. So our standard situation with no Roth conversions has an 80% probability of success. If we come over to the proposed strategy with 10% Roth conversions, that will do, or Roth conversions up to the 10% tax bracket, now your probability of success goes from 80% to 85%. That's pretty significant. And it increases your ending portfolio value on a median standpoint. Keep in mind those are projections. But also, it might dramatically impact what you get to leave behind to your family. So I want to show this really quick. Not account balance. Tax adjusted ending wealth. With no Roth conversions, the reference or the status quo strategy is projected to have 0% tax-free money when they pass away. It would be 100% taxable or tax deferred, or actually none tax deferred because they've been converting it over to taxable accounts, and they'd have $471,000. If you do 10% Roth conversions in this strategy, you could end up with 100% of your money tax-free. So now you're not leaving any taxable anchors to your heirs or wherever you're leaving your money. So it's a lot more money projected, and it's all tax-free. That's a pretty big difference. So if you do a 12% or if you do Roth conversions with a 12% bracket, now you're going to see it's 100% tax-free, but there's less remaining because you converted so much early on that it decreased your portfolio's ability to regrow. So that's the difference between 10% and 12%. They both project to decrease your overall taxes owed in this situation, and they both project to increase your probability of success in this hypothetical situation. But the reason why the 10% is more optimal than the 12% is because it's projected to have more end of life assets. Now, of course, that completely depends on when you pass away, right? So let's let's reset the whole situation here. All right, so now we're back to normal. We've talked about asset allocation. We've talked about Social Security optimization. We've talked about tax strategy and Roth conversion optimization. Last but not least is retirement spending strategy. So there's many different strategies out there where there's inflation adjusted, retirement spending smile, retirement spending stages, floor and ceiling, guardrails, and probably more that this system doesn't recognize or that could build out. But I'm just going to stick with the status quo being inflation adjusted because I think that's the most commonly understood in our society. And that basically just says year one, they have $5,490 of income each year, and that's 80% probability of success. Each year inflation hits, we'll just increase our income by that much to keep up with inflation. And that basically assumes we're going to keep up with inflation and maintain the same lifestyle. However, the reason why for most of our clients we plan around retirement spending smile is because what most studies show and what our experience with our clients has shown is that most people, when they enter retirement, they're one, the youngest they'll ever be in retirement, two, extremely excited to retire, and three, the healthiest because of being the youngest they'll ever be in retirement. So they want to travel, they want to see their grandkids, they might want to buy a camper or a boat or a lake cabin that they've always been dreaming of, or they might want to relocate, sell their house in a small town and move to Florida or whatever it might be. We see more spending early in retirement. Then as they age, their lifestyles naturally decline because they're doing less stuff. So their spending comes down. And then as they continue to age, their spending comes way back up due to medical costs. So that creates a bit of a smile where in the beginning you're spending more because you're younger and traveling or doing whatever it is more, and then you start doing less, but then your health events end up happening and medical costs skyrocket, creating a smile. So if instead of doing inflation adjusted, where we just assume same lifestyle all throughout retirement, adjust for inflation, if we switch to retirement spending smile, where we assume more lifestyle in the beginning and less as we go on with more medical costs in the end, that will bring your probability of success from 80% to 98, the largest jump yet by just simply shifting how we think about retirement spending. So that's a huge difference, right? Whether it's asset allocation, Social Security, tax strategy, or all four, or and more. There's other stuff, Medicare costs, long-term costs, inheritances. There's a lot that goes into retirement planning, but these are just four of the typical ones we look at for a hypothetical situation with all the money being tax deferred. They all have a massive impact. So I cannot stress enough, please reach out to someone you trust or reach out to me if you'd like to have a free consultation to look at your retirement situation to see how you can optimize it with the money that you do have to enjoy your retirement as much as possible while avoiding the risk of running out of money. And last but not least, out of curiosity, let's look at what happens if we do all four. What if I won't go from a moderate asset allocation to most aggressive. Let's say growth, because most people aren't going to go 100%. And from Social Security, let's say we go optimal, tax strategy, we go proposed strategy, and we use retirement spending smile. We can take this person who, scary enough, 3 out of 4 people who enter retirement don't have a plan. So they could very easily end up in the status quo of the situation where they're spending their 5,490, they're adjusting for inflation, they're accepting the required minimum distributions, they turn on their Social Security at 67, and it works. There's nothing wrong with that. But what if they strategized and optimized all of these four situations? They go from 80% probability of success and a median ending portfolio value of 477,000 to 100% probability of success and a median ending portfolio value of 1.3 million. Pretty much three times better. That's a huge difference. Or rather than ending with a lot more money, 100% probability of success, they could probably spend more money. So let's find out, what could they hypothetically spend? And I haven't done this ahead of time, so bear with me while I find that number. They could spend $6,300 a month starting in retirement rather than $5,490. Pretty much $800 more, $810 more per month. That's a big deal. And that's after tax, right? So $810 more per month in retirement by just simply optimizing their plan. So, with all of that, hopefully this conversation was valuable. It's a follow-up to episode 162. Hopefully it answered the commenter's question and request like he asked me to have, and outline the value of planning for not only your, but your and your spouse's lives when it comes to asset allocation, Social Security taxes, tax optimization, spending strategies, and there's so much more that goes into it. With all that being said, thank you for taking the time to watch or listen to today's Money Not Math episode. Please help me provide more value to more people by sharing with a friend, sharing on your social media page, and commenting with a question or a thought. And if you're on YouTube, subscribe. Please, I'd love for you to check out future episodes or past episodes. And if you would like to ask me a question privately or schedule a meeting, please message me directly on the platform you are on or call me at 218-686-3170. Disclaimer, this content is not tax, legal, or investment advice. You should always consult a qualified professional regarding your personal situation. So even though I am a fiduciary financial advisor, we have not signed a contract, and this is hypothetical. So please find someone you trust to build a specific situation for you, and hopefully the concepts in this video brought you value. Thanks, and have a wonderful day.